Hi everyone. I'm going to do this differently. I'm going to record chapter 27 as a lecture, and I'm also going to create this into a podcast. So you're going to see it created into a podcast using a different software, so kind of a short form version. It's going to be up to you whether you want to listen to one or both. So these lectures get into more of the how systems work, where we start to talk about money and we start to talk about lending and banks and kind of what money and what currency means. And we're going to, talk specifically about the US and Canada more than anything else. So I want to start with money. And a lot of us are starting to not think as much about money being physical currency. Um, but it really still is. Okay, so I know most of us, and we'll talk about this in a few slides, walk around with a debit or credit card. I don't carry a lot of cash with me, although I do usually have some just in case. But in general, what I want to talk about with money is it's four different things. Okay, so first of all, it's how you're paying somebody. The formal term for that is called the medium of exchange. Um, and you're giving them a currency, and usually it's a currency. So if it's Canadian dollars or US dollars, they're different in their currencies, but they're still a medium of exchange. So even if you're paying for something in the US, you might pay in Canadian dollars, and then it gets converted to their medium of exchange. But both of those are money. Okay. The other things that you might not think about are all the other little things that happen. So for instance, if you own any stocks, it's a unit of account. Okay, so that's the third item that you see here on here, which is you measure a market value of a stock in dollars. Okay, if it's on the NASDAQ or the S&P in the US, then it's in US dollars. If it's on the TSX in Canada, it's in Canadian dollars. So it's still in that unit of currency for the country, but that is how the stock price is measured. Okay, it's not measured in for instance, and the extreme one, 50 loaves of bread, right? So the currency is the actual value you're assigning to it, um, as well as, assigning it to the costs of goods and services. The other two things that I want to talk about or are um, the last two items here, which is a store of value. Okay, so in other words, that dollar is worth a certain amount and it can change how much you can purchase with that dollar, but $1 is still $1 in 5 years from now. And this is just talking about it in terms of money. It's not talking about how much it can purchase. It's just $1 today is $1 5, 10 years down the road. And the last item is for deferred payment. And all that means is if you tell someone you're going to pay them $5 in 2 weeks, it still has the value of $5 in 2 weeks. Okay, so your currency, that money, um, allows you to also pay for things in the future. Okay, so I think of money not necessarily as the hard, bills or coins because, that's not used as much, but it's purely, what we're measuring value in for something economically. So I want to talk about currency, and this is a really interesting fact. We're going to get to an image in a second of US currency as an example. So there's two different types of currencies. Okay, there's commodity money, which means if I have a $5 bill in that currency, the reason that that's $5 is they're using $5 of a commodity like silver to back it. Okay, so in other words, that $5 is almost like an exchange for $5 worth of silver. Now you never see the silver per se, but you're giving them $5 and that's kind of the guarantee. Okay, so think of commodity money as it is backed by a physical object. Okay, whether that's gold, silver is what it was in the US, or other types of, again, physical tangible items. Okay, so if something happened and your paper was now not worth anything, in theory, you could get $5 worth of whatever the commodity was, silver, to back it. Okay? So most of the time, gold and silver are the most common that were backed kind of in major currencies. So What's interesting is the Canadian dollar and the US dollar are like this. They're not backed by a currency, they're backed by our bank. Okay, so in other words, when you walk around with that, that green $20 Canadian bill, that's not backed by anything else. So the only reason it's worth 20 Canadian dollars is because the government is saying that it's worth $20, in our country. Okay, so the only backing of it is if our economy is strong, okay, and our economy is at a point where that $20 is worth that. And what I mean by that is if we just started printing more and more and more and more of that currency, the notes themselves start becoming useless. And there's no additional item like gold or silver that you could, in theory, exchange for it like commodity money. Okay? So it's very different now. The Canadian dollar and the US dollar are both like that. So I want to show you this image as an example. Okay, so the second one at the bottom, if you look at the top of the image right above United States of America, it says silver certificate. Okay, and that was until 1958. So what that means is that it was backed by silver. So that $1 was basically, here's the currency. In reality, it's backed by $1 worth of silver. And up to that point, there was always, again, a physical object. This would be called commodity-backed money. But now it's not backed by anything. So when we print bills, there's nothing tangible backing it other than the fact that, our government is strong. We're issuing this money to purchase things. And so the difference is, for instance, in Canada, we are the Bank of Canada. In the United States, it's known as the Federal Reserve. So if you look at the banknote on the top here, which would be after 1958, it says Federal Reserve Note at the top above the United States of America. So what that's saying is that's a note from their, centralized United States bank that's giving you $1, and it's saying that that is legal currency to use in the United States. And, because the United States is the largest economy in the world, that dollar also is used to back a lot of other economies. So some places you'll go, you'll be able to do to pay in US dollars, even though that isn't their home currency. I went on a trip one time, and every store, it didn't matter if it was a corner store, a restaurant, cabs, everywhere you went, if something was $2 in their currency, it was an exchange of 2 to 1. You could give them $1 and everybody would take it. The flat exchange rate was $2 of their currency for $1. And it worked like that anywhere in the country. Again, it didn't matter where you went. So there are other countries where the United States dollar is recognized as a currency there. And a lot of that just becomes because of the United States size, their stability of their economy, that their dollar is worth currency or worth, legal tender in other countries as well. So I want to talk about money because we talked about kind of what it is, um, but a lot of us throughout our lifetime at some point or the other are going to have loans from a bank, whether that's a mortgage, whether that's a car loan, whether that's a loan for a recreational vehicle, whether that's a personal or a business line of credit, whether it's a business loan. It's money that a bank is giving you. So I want to talk now about money and how banks can increase the amount of money that's available in the supply for people to spend. Okay? So we're using the United States as an example, but the definitions of money are pretty consistent amongst major economies. Okay, so in Canada, it's the Bank of Canada. In the United States, it's known as the Federal Reserve. And that is the central bank that's responsible for all of the policy that goes on. So that is, how much money is in the money supply, what are the interest rates that banks and those types of institutions can borrow money from their Federal Reserve, okay, to increase the amount of money they have and that they can spend. And they break this down, okay, by what's called the liquidity. Liquidity just means how fast you can take that and it's either physical currency that you hand to somebody or can be converted to physical currency very, very quickly. So the big examples, okay, of the money supply, M1 is including the stuff that is the fastest or the most liquid in terms of creating or giving money from one person or one lender to another. So think about this as physical money, so currency, your checking account at your bank, and I specifically say your checking account. There's other types of accounts that are not included in this because they're not as liquid. So if you have a stock trading account, it is not included under M1 because you have to go through the process of deciding to trade, trading your stock, getting the trade accepted, and then taking that money and moving it to an account like a checking account. And depending on when that is, that can take an extended period of time. Your checking account is an almost, if not instant, cash that can be used. Same with if you have $20 in your hand, you can instantly spend $20. So the M1 money supply, you have to think of it that way. It's the most liquid, going back to the term, and the easiest to give that money to another person or to withdraw that money from a bank. M2 includes everything in that first supply, but it also includes other things like I've been talking about that are not as easy to get the money out. And the big example that I like to use for M1 and M2, and I'm going to go to my next slide, I'm going to come back. So in M2 money supply, I skipped a slide because M1, again, coins, currency, etc. But M2, what I really want to talk about here are other items. So if you have a savings account, and let's say you have $200 in that savings account, you can ask them, or sometimes banks will ask you, do you want to put this in a high interest savings account? So let's say if you leave it in a normal savings account, meaning that you can take that money out pretty easily just by moving it to your checking account, you might earn 1% interest, but you can get a high interest savings account and maybe that earns 3%. So that's 3 times the amount of interest, but you have to leave that money in there for a period of time, 6 months to a year to 2 years. So that's what's called, savings deposits, because what that's, as well as certificates of deposit. So the reason for that is because the banks will take the money that you've put in your bank in the bank as a deposit into these accounts and be able to lend that money to other people. Okay, so that's how we're going to get into later on how we can increase the money supply simply by having them take your money in deposits and lend it out to someone else. So it creates a level of stability because if you decided, you put money in the savings account and then it's not a high interest one, meaning you did not leave that money in for a period of time, then what could happen is, well, what if your car breaks down? Okay, so you instantly can grab that cash and move it. Okay, in a certificate of deposit, okay, you've committed to leaving that in the bank. So you can't pull that money out very easily. If you do, you lose the high rate of interest, or in some cases, you also, number one, can't take it out in extreme instances, or it's a pretty significant penalty where they're saying, okay, well, you're causing us grief because we've taken that money and lent it out. So there's a pretty significant penalty, oftentimes enough that it stops you from pulling that money out and looking to, again, going back to M1 types of money, more liquid forms of cash that you can take out. Okay, so think of them as that way. M2 is just a little stricter than M1 for that specific reason. Okay, so what I wanted to show you, this is actually the slide I was going to get to, just the way recordings work, it doesn't quite work that way. So the M1 money supply is really, I call it money on demand, okay? The money that you can instantly pull out, you can instantly use, whether you're buying something, whether you're going to put a deposit down on something, etc. It's available to you, and as a result, it's less available to the bank to then lend out, okay, because it's risky. They have to keep a certain amount of money, what we call in their reserve, so that they're not, uh, they're not taking money and putting too much money back out into the market and not leaving any money in a reserve for when individuals like myself and yourself take money out of our checking account or regularly make purchases. M2 expands that money supply by allowing those deposit certificates and those savings accounts. And that M2 money that's hanging out here as the bigger umbrella is more of the money that the bank can then use to lend out to others. So if you were going to buy a house, the money that the bank's lending you is coming from deposits and savings of other individuals that they're then lending out. Okay, so that money is always kind of very fluid. So the more money that you're putting into the bank, the more money the bank's going to lend out to others, to which they pay interest for. Okay. So I want to go to this next section and ask, okay, well, again, most of you, when I started this lecture, I said, currency, physical coins and physical bills are not being used as much now. So the question is, where does what we're going to call plastic money? So, taking your debit card, taking your credit card, or items like that, and spending. So instead of having a physical check, okay, I still have checks. I don't think I've used one in several years, but I still have a physical check that I would write an amount out. I would write to who it's for, sign my name at the bottom, hand it to somebody, and they would deposit it. So a debit card is very much like that. You take the debit card, you tap it, or you put in your PIN, and you're telling that your bank to transfer money to that person, whether it's another whether it's a company, even when you use an e-transfer online, it's the same thing. You're telling them to transfer money from your bank account to the other person's institution. If that's a friend you're sending money to, or if you're buying something and paying through e-transfer or a debit card, like that. Okay, so that's basically the called the paperless form of a check now. Credit cards are different, and a lot of us use credit cards now to get the points. It's interesting because I use a credit card, mostly for the points or the cash back quite a bit. But you're not using your money. So it's easier actually to spend more money using a credit card because you're not considering what's directly in your account. So if you pay with your debit card, that money is gone out of the checking account that is linked to your debit card. With a credit card, that money is taken out of the credit card company's checking account or bank account, and you have a promise to pay them back. Usually it's 30 days from when your statement comes out to them. But that money is not coming out of your account until you take the money out of your account and transfer it to them. So it's different than a debit card that way. And the big difference is credit cards charge a higher percentage to companies in order to use it. So they might have a small fee on a debit card because the bank is just taking the money and directly transferring. The credit card will be a higher percentage fee, meaning that the credit card company is making an amount per transaction for when you're using their credit card. But the difference with that piece is that they transfer some of those savings to you. So net, the credit card's making a ton of money. So the more of us that use our credit cards, and I'm in that boat too, I use it quite a bit. The credit card company makes a certain bit of money. They transfer some of that to you as incentive, like 1% cash back, or rewards like Scene points or Avion points, or whatever you might want to call it, Aeroplan points too. Okay, the last piece of plastic money, or I'll say plastic money with the cards, I would call a smart card. So if you have a meal plan on campus, it's an example of swiping and it's deducting a preset amount of money. I also think of Visa gift cards like this too, because it's this preset amount of money on that, or any type of gift card where it's a preset amount of money that's in there and that's available to use either at a certain store, or if it's a Visa gift card, it's used anywhere that Visa is accepted. Okay, But as you can see, each uses a different amount. The debit card is limited to the amount of money in your checking account. If you go over that amount, a lot of people have what's called overdraft protection, meaning that the money will still come out. You will just have to pay a fee because you technically don't have that money in your account yet, okay? But it will allow your checking account to go below zero into the negative to a certain extent. It's called overdraft protection. A credit card, you can just keep swiping, and usually it's a pretty large limit. Credit cards are pretty free to give you limits of, $1, $2, $5, $10,000, upwards of even $25,000 to $30,000 to put on a credit card. And it's just immediately available to you, regardless of whether you have the cash today. A smart card's limited at whatever it is. If it's a $100 on your meal plan, you have $100 on your meal plan, it will decline after that. So if you can see, all of these are just different ways of physically moving money. Okay. All right, so let's continue. I've talked now about different types of currencies. I've talked about debits and credit cards and different types of ways to pull money from a bank. And we've talked about the different types of money in a bank, from the most liquid, which is the M1 currency, to I'm not going to say least liquid. I'm going to say less liquid ones like savings accounts, because there's more items in there that are hard to move. Okay, like if I have equity on my house, that's hard to move. I have to sell my house. That's even less liquid. It's not included in M1 or M2 money. Okay, so banks, everybody, most of you, if not all of you, will have a bank account. Okay, which is just a record on a computer. There used to be these little books. I think some people still have them. The books that you put in, it prints stuff out, and it updates your transaction log. I don't think I've used one of those, in probably 20 or 25 years, but there used to be those. But otherwise, it's just an amount of money on a screen. It's kind of hard to think of it that way because you log in, you're like, oh, there's my money, but you can't physically see it or touch it, right? And how banks make money, okay, is you can typically put your money in for free, right? They'll give you a free checking account. There really isn't any fees provided you keep a certain amount of money in the account. And the reason for that is banks can take that money and lend it to another person and earn interest on that money. So banks are earning money when they give that money to someone else and that person is charged interest. So my mortgage at my bank, they're earning interest on me for my mortgage. If you have a personal or a business line of credit, they're earning interest on those pieces as well. Okay, so it's the lending component of a bank where they make money. For you, that's why they're encouraging you to put your money in. And even there are some incentives. If you have a certain amount of money in certain types of checking accounts, you'll get bonuses like your e-transfers don't cost anything, a certain number a month or an unlimited amount a month, etc. Okay, so each time there's a transaction, the bank charges a fee, other than you putting physical money in the bank, and that is really how banks bring money. Okay, or sorry, make money. And it's a nice system because if we didn't have that, then it would be more difficult for you to and for me to purchase items like, a vehicle that you might need, a house or a condo, if people have a condo, because you'd have to have the cash to physically hand to somebody versus being able to take money from the bank and pay it back over a period of time. Okay, so banks are, the big term of it is financial intermediary. Okay, so that means that they operate between what are called savers and borrowers. So if you're inputting your money in your bank account and you're not immediately spending it, that classifies you as a saver. Okay, when you take money to use it for something else, that classifies you as a borrower. So everybody, if you have loans with a bank and you have money in the bank, you are classified, weirdly enough, as both a saver and a borrower, depending on which accounts that you're talking about. Okay. They're also known as what's called a depository institution. Okay, so Scotiabank, RBC, CIBC, Bank of Montreal, all of them allow you to bring money deposits and use that money to make loans. Okay, again, going back to my previous comment where that is how banks were making money. So let's look at this kind of illustrated. All right, so this is you. Okay, on the left, the green, you're a saver. Okay, you've got $100, you're going to deposit it into the bank. Okay, so what happens is you deposit it to the bank. The bank is the intermediary, meaning the person in the center. They're going to take, a portion of that money. They can't take your entire $100 because they have to keep money in reserve, but maybe they're going to take $90 and loan it out to a borrower. Now, that borrower is going to pay that $90 back with interest. So they might end up paying back, $110 to the bank. So the bank's made $20 off your $100 in money. Okay? They give you some of that back if it's in a savings account, for instance, through interest payments, but they also give it back in money that you save from transactions. Okay, so if you're not being charged to pay another person, whether it's an e-transfer, whether it's items like that, I also consider that not interest payments, but just, an incentive to have your money within that account. Okay, so they can quickly send money to someone across the country versus you trying to physically mail $20 to a person, in Texas from Canada, right? They don't like mailing money, easier to go through a financial institution. So them acting as an intermediary is a service to you, right? So it is in your best interest to be storing money in the banks as form of deposits, and then it allows them, to loan it out, but also, as you're going to see in the later slides, increase the amount of money that's available in the market. Okay, so let's keep going and let's talk now about what a bank's balance sheet looks like. Now, you would have seen this in an accounting class as its most basic form, but all we're going to show you are through some simple T accounts how a bank can increase the amount of money available in the market. Okay? So a couple terms that I feel like you already understand or you've heard from other courses before, but I'm going to repeat them anyways. So the balance sheet lists assets and liabilities for the bank. Okay. The terms are a little different in this economics terms. You might hear assets equals liabilities plus owner's equity, items like that. So an asset is something the bank owns. A liability is a debt. And the net worth is how much is left over. That's what's referred to as net, the owner's equity or shareholders piece in the economic world. I will call it net worth. Okay, so the difference between the bank's assets and their liabilities. Okay, and then at the end of the day, what's called bank capital is what the other term they use for net worth. So let's look at a very simplified T account. So on the left-hand side of this T is your assets for a bank, and on the right-hand side, we'll call the liabilities and net worth. And what I really want to emphasize here is this is this is the opposite when I compare this to you as a consumer, as somebody putting money in the bank. I use consumer, from the marketing world, but this will be the exact opposite, and I'll explain that in a second. So for assets for a bank, for instance, loans are an asset because they are interest earning and it's money that they've given out that they're getting money back in. So a loan is an asset for a bank, as well as, government securities. That's money that's secured with the government. And the last item is reserves. That's actually their cash in hand. Okay, so you can see a loan is a liability. If you have a mortgage, that's a loan. You would classify it as liabilities for you. But from a bank's perspective, it's an asset because they're earning interest on it. Okay? So a bank's liabilities are their deposits okay, which is the amount of money that people have given to them. Okay, so the reason that that's a liability to a bank is they owe that money to every person that's put the money in the bank. And all of you that have deposited money into a bank, that's a liability, because if you all show up and try and withdraw your money at the exact same time, they have to find a way to make that money available. We'll get into that in another lecture. When that happens and the bank does not have enough funds, it's called a bank run, and that's how banks can collapse. The last piece is their net worth. Okay, so that's additional cash, that they have sitting here. So just like in the accounting world, their assets here are 11 million in total, and it has to equal the liabilities and the net worth, which is 11 million here on the right. So the T account looks good, everything's balanced, and now what I want to show you is how a bank increases the money supply. So before we get to that, I talked about reserves in the last slide. That's money or funds the bank keeps on hand and does not loan out or find other ways. Government securities are a type of bond. So by law, and this isn't just the Federal Reserve, Canadians like this too, uh, they have to have a certain amount of money on reserve. So they can't, so I go back to a couple slides ago. If you deposit $100 to a bank, they cannot go turn around and loan that entire $100 out. If their requirement is they have to keep a reserve of 10%, that means they would have to keep $10 of your deposit as a reserve, and they could take the $90 or the remaining $90 of your deposit, I should say, and loan that out to somebody else. Okay, so that's what it means when it comes to reserves. Okay, and that's again to protect us. Okay, and to make sure that the banks remain viable. Okay, and they're smart in how they're loaning their money out. Okay, so like I said, problems with how they go bankrupt. Okay, so there's a couple things. I want to go back to when we talked about the money supply. And I said M2 money includes what are called certificates of deposits or savings accounts that have higher interest rates. So the bank is trying to guarantee that your deposits will stay in for a period of time. And when that doesn't happen, what that means is you have a time mismatch, which is the second point here between your assets and your liabilities. So for a bank, a liability are their deposits. And if people are pulling the money out, okay, faster than, people are paying their loans back, that mismatch could cause the bank to run out of money because they've given your money to another person in exchange for interest and them paying the loan back. Okay. The second way that that happens is if people default on their loans and they can't pay them back. Okay. And so a lot of times I want to use the example of a mortgage for a house. So if you can't pay your mortgage, you could potentially foreclose, the bank could foreclose on your house, meaning take your home. Now you might think, okay, well, that's an asset. Okay, so if I can't pay it back, well, they take the home, they get the money from the home. They don't get that immediately. The home still has to be sold, and oftentimes it's sold at a discount because the bank then needs to get that money back to make sure that they don't have a mismatch of their assets and their liabilities. So if too many loans default, okay, meaning that people can't pay them back, that's where it creates a significant risk for a bank. Okay, so in order to reduce the risk, the biggest thing that they like to do is to diversify. Okay, so let's say all of their money went into mortgages, okay, and our entire real estate market crashed. They're not diversified. But if they're in other instruments like a government bond or diversifying into other areas that they can make money, if the real estate market crashes, that's bad for them, but it's a percentage of their portfolio versus the entire portfolio. Okay. All right. So now we're into the point that I promised you we were in a couple slides ago, which is how banks create money. So I want to talk about, let's start with the very basic piece here. Okay. So let's just say a bank has never loaned anything out. This very first T chart here, okay, shows that they have a reserve of 10 million, okay, as an asset, and a deposit of 10 million. Okay, so in other words, people have put $10 million into this bank. They have not loaned any of the money out. All right, so I'm going to go back to my example. Let's say that the bank has to keep 10% of the money as reserves. So 10% of 10 million is 1 million, which is the number hanging out here. Excuse my bad writing here on my computer. So they're going to take $9 million and loan it out to a company. In this case, it's called Hanks Auto Supply. Okay, so on the left-hand side in their assets, now instead of a reserves of 10 million, they have $1 million in reserves and the remaining $9 million as a loan. Okay, so now I look here and on the right-hand side, they still have $10 million in deposits. Okay, so rather than holding on to that money, they've loaned it out. So they've kept their required reserves, and now this is still an asset because it's paying back interest as Hanks Auto Supply pays the $9 million back to them over a period of time. All right, so what happens? That bank, okay, was called Singleton, gave the 9 million to Hanks Auto Supply. So now Hanks Auto Supply, they're going to go to their other bank. Let's say it's First National as this example here. They're going to deposit that $9 million in First National. So now First National gets that $9 million, okay, as a deposit. And they could now choose to take the money from Hank and loan it out again. But again, if I keep the 10% limit going back down to the bottom here, they can't loan the full 9 million. They can loan $8.1 million, okay? Because that's, 10% of 9 million is 900,000. And the deposit's still 9 million. So they could take that 8.1 million of that amount and loan it out to another company. Okay, let's say it's Frank's Auto Supply instead of Hank's Auto Supply. Okay, so actually no, I even says it here and I forgot. Jack's Chevy dealership. Okay, see here? So that money is just continually being loaned and loaned and loaned. So this kind of sounds like it's a scheme, kind of a pyramid scheme where it's just all going to come tumbling down, right? But at each point in time, provided people are paying their interest back, First National is going to earn interest on this 8.1 million. And if Hanks Auto Supply is still in business, they're going to make money on their 9 million. Okay. And where this really comes into play is if you have ever tried to get a loan for a house, it's different because a house is a physical object. Your house is required to be insured, typically for that mortgage, and there's proof of insurance. And if the bank doesn't get the money from you, they take the house and they take the money. Where it gets difficult is if you try and get a loan from the bank where there's nothing tangible. In other words, the word for that is called collateral. There's no collateral. So I use an example of if you're buying a company, let's say you're buying a consulting company that does a lot of, does a lot of reports or design work or something. When you're purchasing one of those companies, you're not necessarily purchasing physical assets unless they have, a building you're purchasing. But if you're just buying into a business, you're basically buying, the existing projects they have, as well as, goodwill that they've built up in their firm. So, but that isn't necessarily a tangible item that the bank can take from you and use elsewhere. Okay, so oftentimes the reason that this works where the money continues to get borrowed is because there's some asset or there's something, as collateral to back it. Okay. So in this last piece, what I want to show you is I only used the example of now we're on to a third bank. So we had Singleton, First National, and now we have over here Second National Bank. That Jack Chevy dealership is going to put the $8.1 million in as a deposit in their account okay, with this bank, okay? So now that original $10 million, $9 million was loaned to a company and then 8.1. So we've actually expanded the money supply by almost $17 million by banks loaning that money out multiple times, okay? The only reason that that's possible is because there's multiple banks in the system. If it was one bank and you took that money and you gave it to another person at your bank, it doesn't necessarily work that way. Okay, so there has to be multiple banks in the system to make this expansion of the money supply work. And that's why you saw with this, we had Singleton, then another bank called First National, and another bank called Second National. So each of these banks is taking a portion of that money and reloaning it out. Okay, so if there was only one bank, this entire scheme of increasing the money supply or banks creating money wouldn't work. And I say scheme, but it is just how this money is then used in multiple ways. And each time interest is being earned by that particular bank. Okay. So what this means is, as you saw, we went from the original 10 million and we added 9 million to one bank, 8.1 million to the other bank. So that's called taking that money and multiplying it out. Okay, and the way to figure that out, okay, it's called the money multiplier formula, is to take 1 divided by the reserve. Okay, so that multiplier means how much more money can you make from this? Okay, so if the reserve is 10%, 1 divided by 0.1, which is 10%, gives you a value of 10. Okay, so all that's trying to do is say they could loan that money almost 10 times over to get to a point where the money works. Okay, so this money multiplier is difficult because if banks start to overuse it, there's that very, very fine line where we started with an initial 10 million and we have all this extra cash, right? So there comes a point, where they have to decide how much they're going to hold in reserves or not. So if a bank is looking at a recession, okay, then a bank would choose to hold more reserves because our economy is going to look to start shrinking, okay? And what typically results in a recession, our economy shrinks and there's people that can't pay their money back. And if they can't pay the money back, those defaults also cause it to shrink. So the bank has to hold on to reserves, more actual money in their accounts to be able to deal with the uncertainty that happens with this. Okay, the stronger an economy is, so if interest rates are relatively low, people are spending, our gross domestic product is going up, our stock markets are rising, banks would carry less reserves, closer probably to the minimum. And then if things start to go bad and there's inflation and there's a lot of things happening, banks might hold on to some additional cash. Okay. So like I said, in a recession, they're likely to hold kind of more money. So, and in that case, you might see people depositing less cash. There by being less cash in the accounts because people have spent money during the recession and have less available. There's less jobs in the market, etc. So all of these kind of bigger macroeconomic conditions affect how the banks, can keep money in their accounts and lend money out. Okay. So that's it for this lesson. I want to just say thank you for listening to this. I know online is a different format when we're learning through a recording. I also hope that you like the podcast that I'm about to create. I'm about to do that right as this recording ends. So thanks everybody, and we'll talk soon.